The topic for today is about market turning points. There are two kinds of turning points. One is the market turning point that caused the whole stock market to move, to reverse. And the other is the company turning point that applies only to a company. Why turning point is important? Because turning point sets a trend, and also it reverses the trend. And if you understand the turning point, it means it's danger or opportunity for you. So turning points are very important as far as you are concerned. Some turning points are very obvious. However, most of them are not that obvious. That's why you have to learn how to identify them. There are some elements about a turning point. One of them is uncertainty. And whenever there is uncertainty, it's always bad. Stocks always fall. The other is surprise or shock. And this may be a good surprise, pleasant surprise, or is a bad one. Then the stock will move accordingly. Turning points also have two kinds of consequences, short-term and long-term. Let me give you a few examples. First one is a bad one. It's a shock, then followed by uncertainty. This is the worst one. Remember the collapse of Lehman Brothers, a very well-established investment company, back in September 2008, only last year. And because the collapse of Lehman presented a shock, so the banking industry froze their credits. They were afraid to lend. And the US economy became frozen also for a short time. This led to a worldwide recession, and of course the stocks tumbled for almost 6 months. The consequence lasting for about 6 months until early March this year. The second example I want to give you is a pleasant surprise and reduced uncertainty. This is always a good turning point. Remember, back in March the 10th, Citigroup announced that they are making the first profit after so many months of huge losses. And this good announcement was followed by other major banks. And immediately, the market turned around from their 12-year low. Now, everybody says the market turned around. What is the market? Is the market some kind of a mystery? No. Market turnaround means the big guys with a lot of cash moved in and arrested the decline. It's that simple. When there are people buying, the market did not fall anymore. And after they arrested the decline, they also started to accumulate, because it's a good opportunity to accumulate when the stocks are so low. So this marked March the 10th. On that date, it marks the beginning of recovery for the financial sector. It also marks the recovery for the worldwide recession, the beginning of the recovery. The third example I want to give you is about uncertainty, which is always bad, and then followed by a shock. This thing is very dangerous because it's not obvious, very hard to see. If you look back on the bank stocks, you'll find that the financial stocks was already falling since November 2007, several months before the real crisis began. So this was falling gradually, and very few people noticed it. The reason is because of the uncertainties and risk of the housing bubble. The big guys, the insiders, know that the housing bubble cannot sustain. Only the public continue to buy with the subprime loans offered to them. So it took several months for the housing bubble to slowly burst. And until September last year, Lehman Brothers collapsed. The fall of Lehman Brothers actually made the burst of the bubble official. Now, I want to help you understand other turning points too. Besides the examples I have given, an important factor that brings about the turning point is inflation. Inflation can occur in many forms. You look at the creeping demand for oil increasing. This, we're sure, will eventually lead to inflation, but when, we don't know. So this is not very obvious. But it can create inflation fears. And the fear of inflation can cause a short-term decline of the stock market. The thing that we are afraid of is the real inflation, because when real inflation occurs, it's very hard to clamp down, very hard to reverse it. So it can cause a long-term decline of the stock market for 1 or 2 years. What event can really trigger an inflation nowadays? Of course, the disruption of oil supply can always trigger an inflation. Secondly, the rise and fall in interest rate. Interest rate is another important factor. The rise and fall in interest rate can create opposite results in the stock market. A fall in interest rate means the stock market is likely to rise, and a rise in interest rate will cause the decline of the stock market. Sometimes we may see mergers or takeovers. This comes as a wave, and that buoys the stock market for the short term. New industries can develop, such as the solar and other green industries right now, can bring long-term opportunities for the stock market. Now we come to the last important turning points, which has nothing to do with the economy. It just has everything to do with money making. When there's a boom, when everybody is optimistic, we create a bubble, because the stock market is emotional in nature. And when there's a bubble, it will burst finally, because the temptation to cash out is very high. So you have a boom leading to a bust, a turning point. But after a bust, all the stocks will come down to record lows. Then this will present very great investment opportunities. Then the big guys will rush in and buy and accumulate. In that case, the record lows will create a turnaround. So in this case, a bust will create later a boom again. So you have this bust and boom situation occurring in the stock market many times.